Hi, everyone. Most business owners who accept credit cards have seen the word interchange on their processing statement at some point, and almost none of them know what it actually means. Today, we're going to fix that because understanding interchange is the single most important thing you can do to evaluate whether you are getting a fair share on your processing costs. My name is Robert Foho, and this is Payments for E-commerce. Now, here's something that I find quite remarkable. Most e-commerce operators can tell you their revenue, their cost of goods, their ad spend, their return rate, but ask them where their processing fees actually go, and most of them have no idea. They know they are paying something. They just don't know who is getting it or why. And that gap in understanding is exactly what processors count on, because the moment you understand how interchange works, you have real leverage in every conversation about your processing costs, even if you never switch processors at all. So let's start at the beginning. Interchange is a fee paid to the bank that issued your customer's card. Not to your processor, not to Visa or Mastercard. This is a fee to the bank. Chase, Bank of America, Capital One, whoever issued the card that's being used. Every single time a customer swipes, taps, or enters their card number on your checkout page, that issuing bank collects an interchange fee. The rates are set by Visa and Mastercard, not by your processor, and they are published publicly twice a year in what are called interchange tables. Your processor did not invent these fees and cannot change them. They are a fixed cost of accepting cards. Visa and Mastercard each publish their full interchange tables on their websites. Anyone can download them. They run about 20 to 30 pages, sometimes more, and they cover dozens of different card categories and transaction types. The rates vary based on three main factors: what kind of card your customer used, what type of transaction it was, and what category of merchant you are classified as. So, for example, a grocery store pays a different interchange rate than a software company. A debit card transaction costs less than a premium credit card transaction. And a card that was physically present, tapped or swiped at a terminal in person, costs less than a card that was entered online, which brings us directly to why e-commerce merchants pay more than almost everyone else. Every transaction on your e-commerce store is what the card networks call card not present. The card never physically touched a reader. The card holder typed in their number, and from the card network's perspective, that transaction carries more fraud risk than one where someone tapped their card at a counter. So the interchange rate is higher, and that is to compensate the issuing bank for taking on that additional risk. This is not your processor's decision. It is not negotiable. It is built into the network rules, and it applies to every e-commerce merchant equally, regardless of which processor you use or how long you have been in business. So the question is not whether you pay CNP rates. You do. The question is what happens on top of those rates. Let me give you some real numbers. And I'm pulling these from Visa's published interchange tables, which is publicly available at usa.visa.com. For e-commerce transactions, the rates vary significantly by card type. Standard consumer credit on the CPS e-commerce basic category sits at the lower end of the range. But Visa Signature and Visa Infinite, which are the premium cards most consumers carry today, run in the range of approximately 2.1 to 2.4% or higher on card not present transactions. And here's the important part. Most of your customers are not paying with basic consumer credit cards. They are paying with rewards cards, travel cards, Visa Signature, and Infinite products, which means your blended interchange cost is not sitting at the floor of the range. It's sitting somewhere in the middle to upper end before your processor adds anything on top. Now, this is something that confuses a lot of e-commerce operators. Your processing bill goes up one month and down the next, even when your volume is roughly the same. The reason is your card mix. Your customers are not all using the same type of card. Some are paying with debit cards, which carry much lower interchange rates. Some are using basic consumer credit. Others are using premium rewards cards or Visa Infinite products that carry the highest rates in the table. The mix changes month to month based on who is shopping. More customers paying with premium cards means a higher average interchange cost for that month and a higher overall processing bill, even if your revenue did not change. This variability is completely invisible on a flat rate statement because the processor absorbs it. On Interchange Plus pricing, you see it clearly as a line item. Now here's where this becomes actionable for you. When you are on flat rate pricing, let's say Stripe at 2.9%, Shopify at 2.6%, or Square 2.6%, the processor is charging you one fixed rate regardless of what card your customer uses. They pay the actual interchange cost on the back end, which varies by card type, and they keep the difference between their flat rate and whatever interchange actually costs on that transaction. So on a debit card transaction where interchange might be under 1%, that spread is enormous. But on a premium rewards card where interchange is already at 2.3, 2.4%, that spread narrows. The processor wins on average across your entire volume. On Interchange Plus pricing, in contrast, that spread disappears. You pay actual interchange as a pass-through cost plus a fixed, transparent processor margin. The variability is yours to see, and the savings on lower cost transactions are yours to keep. Now here's the one thing I want you to walk away with from this video. Interchange is not your processor's fee. It is a network cost that goes directly to the bank that issued your customer's card. Your processor's fee is whatever they charge on top of interchange, and that is the number that is actually negotiable. Most flat rate processing statements do not show you this distinction at all. Everything gets bundled into one line item, and you have no way of knowing what the underlying cost was or how much margin your processor kept. Interchange Plus pricing separates the two costs completely, and that transparency is what gives you real leverage as a merchant. If you've been watching this series and you want to know what interchange is actually costing your store specifically, not the general range, but your actual blended rate based on your real card mix, that is exactly what I look at in a free payment cost analysis. I'll pull your processing statement, I'll break down what you're paying in interchange, what your processor's keeping, and what your all-in effective rate actually is. Send me a message or visit the link below. No pitch, no obligation here, just a clear picture of your actual numbers. And if you found this video useful, please subscribe to the channel, and I'll see you at the next one.